While certain stocks like Costco and Nvidia have seen double-digit gains in the last month, today we'll be looking at 3 deeply discounted stocks whose share prices are moving in the opposite direction, and as a result seem like particularly great pickups for your portfolio as we jump into June. But real quick, before we get to those, I want to hear from you. Leave me a comment below and let me know which stocks you currently have your eye on. I'd be curious to hear what you think is looking good. Now, stock number 1, guys, is going to be Old Dominion, ODFL, which I don't think I've ever talked about before here on the channel, but it's a really interesting company. Old Dominion is one of the country's leading trucking companies, and they specialize in what's referred to as less than truckload or LTL operations, which typically pick up multiple shipments from multiple customers on a single truck, and we can see that depicted in the top part of the image here. From there, the LTL freight is then routed through a network of service centers where the freight may be transferred to other trucks with similar destinations. In total, Old Dominion has 260 service centers across every state here in the continental US, 90% of which they own, so it kind of has an interesting real estate aspect to it as well. And this LTL structure seems to be working incredibly well for Old Dominion, seeing as the company has been a pretty aggressive grower over the years with a near 12% revenue CAGR going all the way back to 2002. Now, having said all of that, as of late, Old Dominion's share price has definitely taken a turn for the worse, and as we can see here looking at Seeking Alpha, just in the last 30 days, Old Dominion is down 18.5%, so that's quite a big drop, and this leaves them with a year-to-date loss of 14.6%, and the substantial drop came as a result of their quarterly earnings report from the end of April, which in my opinion looked pretty decent. Even though revenue came in just below expectations, it was still up year over year, and the company's earnings were right in line with what the analysts were looking for. But with this though, the volume of shipments, both in terms of tonnage and number of shipments, were down, which could indicate that there's less demand for freight services right now, which obviously isn't great news, and this is what pushed the share price down so much. The silver lining to this though, as we talk about all the time, is that as the share price comes down, that dividend yield just gets pushed up. And while Old Dominion doesn't have the highest starting yield, we can see it's only 0.6%, which is definitely nothing to write home about. This is still considerably above the company's 5-year average yield of about 0.4%, to the tune of about 55% above that average there. So that's quite a big difference. And if we take a look at the rest of the dividend stats, I think all of these are looking really good. I mean, starting there with their payout ratio, it can hardly get lower than that, guys. 15.2%, that is extremely low. And in my opinion, the 5-year growth rate here more than makes up for that low starting yield. That 5-year growth rate, you'd have a hard time finding a higher one at 35.7%, and they've been growing this dividend for the last 6 straight years. Over time, with a dividend growth rate like that, your yield on cost will grow to be pretty dang impressive. So if you're someone who has a lot of time on their side and you don't need that income today, I think Old Dominion could be a good company to keep in the back of your mind. If you're looking for another great dividend growth stock, I definitely think this is one to consider. All right, guys, now the second stock is one that we first started talking about here a few months ago, and it's still looking like a great buy today. This is AGCO, which behind John Deere is one of the country's leading manufacturers of agricultural equipment. So they make things like tractors, watering systems, feed storages, stuff like that. And earlier this month, AGCO reported a miss on both the top and bottom line in their quarterly earnings for the second time in a row, actually. And they saw a 12% year-over-year decline in revenue, which definitely knocked the share price down a notch. And taking a closer look at that, just in the last 30 days, AGCO is down 7.25%. So that's a pretty big drop in a short amount of time, which leaves them with a year-to-date loss of about 10.25% and has them right there at their 52-week low. And now with this drop in share price, guys, it's going to leave the dividend yield sitting at about 1.1%, which once again in its own right is not going to be the highest dividend yield, certainly higher than what we saw with the last stock, but this is about 31.4% above the company's 5-year average, so that's not nothing. And if we take a look at the rest of the dividend stats, I didn't think it'd be possible, but we actually found a lower payout ratio than what we saw with Old Dominion here in AGCO. This is coming in at 8%, a single-digit payout ratio. These are very few and far between. This is like a unicorn payout ratio. But anyway, love to see that. And the 5-year growth rate's also looking great at 13.75%. And they have a 10-year dividend growth streak, so that's pretty solid as well. Anyway, guys, stock number 3 here is going to be our worst performer of the day by a long shot. We're talking about Starbucks, and the reason for this company's decline at this point is probably old news. But just to quickly recap, Starbucks reported a pretty abysmal earnings miss last month that completely blindsided investors. It was not at all what anybody was expecting, and to make matters worse, the company's CEO went on CNBC and just got completely grilled by Jim Cramer, which definitely added fuel to the fire, and I think made the share price drop even more. And if we take a look at the share price, we're performance, we can see right here is where they just jumped off a cliff. And it's pretty crazy. They went from being at almost $90 per share on April 30th to the next day being sub 75, even sub 74. So they got into the low 70s with this big drop. But anyway, that's going to leave them with a near 10% decline just in the last 30 days. So a very big drop there. And then year to date, Starbucks is down almost 18%, which is pretty crazy. Now, as many of you guys know, Starbucks is one of my favorite companies, and it's one of the larger positions in my portfolio. I think it's like my fourth largest individual stock position. But anyway, I've been getting a lot of questions about what I'm doing with this stock. And I've actually been adding to my position all month long. I think so far I've picked up about 8 shares this month. And if we take a look at my dividend portfolio tracking spreadsheet, which you can start using for free, there is a link to download this spreadsheet in the description of the video. But anyway, we can see that leaves me with almost 61.5 shares of Starbucks at an average cost of $88.60, which is pretty good. I was over $90 before I went on my buying spree this month, so I'm happy to see that number coming down. And along with that, I'm also happy to be picking up some shares at a near 3% dividend yield, which is pretty high for Starbucks, and is actually about 41% above the company's 5-year average yield. Now with that, guys, taking a look at the rest of the dividend stats, the payout ratio coming in at about 61.5%. So compared to most other dividend growth stocks, Starbucks does have a bit of a higher payout ratio, which is something to keep in mind, but still the 5-year growth rate's pretty respectable, about 9.25%, which is albeit the lowest of the day, but still in its own right is pretty nice. And they've been growing this dividend for the last 13 years. But anyway, guys, Starbucks is another great dividend growth stock to consider. And I think all 3 of these companies are really great contenders if you're looking to make some additions to your portfolio. And along with those, I think there are still quite a handful more other companies out there that you need to keep your eye on. The first of which is going to be Archer Daniels Midland, ADM, who's actually pretty flat in the last month. They're down by just a hair, but year to date, this company is still down over 16%. So I do think this is one to keep your eye on. And then along with that, guys, keep your eye on AWR, who's actually seen a pretty nice gain in the last 30 days. They're up about 6%, but still year to date, AWR is down almost 8%. So I still think this is one to watch. And then the next one is Franklin Resources, who got smacked in the last 30 days. This company is down over 7%, which leaves them with an even bigger year to date loss of about 21.7%. Anyway, moving on, this next one is BMY, Bristol Myers Squibb. I know a lot of you guys out there are buying some BMY, and rightfully so. It's down over 15% just in the last 30 days, and year to date, BMY is down about 20%, and they are also right there at their 52-week low. So this is definitely one to consider. And then next up, sticking to the healthcare sector, keep an eye on CVS, who's down a whopping 18.5% in the last 30 days. That is just crazy. And year to date, CVS is down closer to 30%, and they're also pretty much right there at their 52-week low. Anyway, guys, this next stock here is still in the healthcare sector. This is the 3rd one in a row. Humana, who's actually seen a really nice gain in the last month. They're up 9%, but still year to date in 2024, Humana is down almost 24%. So overall, still seeing a net loss. Could be a good one to keep an eye on. And the healthcare stocks just keep coming, guys. This next one is Johnson & Johnson, who's done okay in the last month. They're only down 1/3%, but year to date, J&J is still down 6.25%, and they are pretty dang close there to their 52-week low. So could be a good time to swoop up some shares of J&J. But anyway, moving on now to the consumer discretionary sector. This next stock is Lowe's, who's down 7.25% in the last month, and year to date, Lowe's is down 3.3%. Nothing too crazy, but you know, it's really starting to come down as we can see there. So I definitely think this is one to watch. Anyway, now moving on to McDonald's, guys. Definitely watch this bad boy here. The last month, McDonald's is down almost 6%, and year to date, this company is down 13%. So that's quite a decent drop so far in 2024. Anyway, moving on, guys, this next stock, which is Nike, just can't catch a break. This stock is down 3% in the last month, which is not too bad, but year to date in 2024, Nike is down 15.5%, and they're really not too far off there from their 52-week low. So this could be a good one to keep an eye on. Anyway, guys, the next one that I think you need to watch is SJM, which is the J.M. Smucker company. In the last month, SJM is down 6.3% almost, and then year to date, this company is down over 13%. That's quite a big drop for these guys, and they're really not too far off there from their 52-week low. They're basically right there. Anyway, guys, next up, keep an eye on Target, who's seen a very big drop in the last 30 days. They're down 12.25%, but still year to date, Target's barely in the green. They're up about 2%. So maybe see how this next one moves in the upcoming month. We'll see what happens with Target from here, but it could be a good one to keep an eye on. And then along with Target, guys, and the rest of these, I think you need to keep your eye on Zoetis, who's seen a really nice gain in the last month. They've rebounded quite nicely. They're up almost 13% just in the last 30 days, but year to date, Zoetis is still down almost 14%. So it still could be a good time to buy. If nothing else, I think it's a good one to keep an eye on and keep in the back of your mind. Anyway, guys, those are all of the stocks that I think are good ones to watch right now. And in this next video right over here, I'm telling you about 3 more that are the exact opposite. These stocks are trouble, and you would definitely regret buying them. So click right over here to find out which ones they are, and I'll see you in the next one.